This is the one technique I and many others have used to be able to boost our credit scores quickly in less than 30 days. What's up, y'all? My name is Tomy Boboy, and if you're looking to improve your credit score, then this is the video for you. Here we're going to be breaking down exactly how the credit score works and a technique that you can use to be able to quickly boost up your credit score and get a lift just by doing one simple thing. Your FICO credit score is broken up into 5 categories. So the first section we're going to talk about is actually what accounts for 35% of your score, and that's going to be your payment history. Now, your payment history, pretty much as long as you're not missing any payments, it's going to stay positive and you'll get that full 35%. The way you start losing points is by you missing payments. So whenever any type of creditor reports that you're 30 days late, 60 days late, 120 days late on an account, that's when it can negatively affect you. Now, most people think that if you're 30 days late or 60 days late or 90 days late, whatever amount you are, that they'll all impact your score the same. And that's actually not true. Now, what happens is if you're 30 days late, that will have a negative effect on your credit score, but it won't have as bad of an effect as if you're 60 days late, right? That's going to give you an even more of an impact. The reason being is you've now shown to any creditors or anyone who's looking at your credit report that you've now gone 2 months without paying a bill. So the way that banks are going to look at it is, okay, if you're 30 days late on a payment, it's understandable, right? Maybe, for example, you forgot to pay the bill or something came up where you weren't able to pay, and that's understandable. And if you're able to catch up the following month, then you'll just have a 30-day late and that's fine. But once you go into 30 days to 60 days, that now shows that it's now been 2 months since you were supposed to pay this bill. So whatever your situation, it's for some reason you haven't been able to collect enough money to be able to pay off this bill that you have, and you're now 2 payments behind, right? And then once you start getting into the whole 90 to 120 days late, at that point, like the way the banks are looking at it is now you're just straight up not paying the bill, right? At that point, you know for sure there's no mistake that you forgot or anything like that. You are now completely neglecting that bill and you haven't made any payments towards it, okay? So you can see by just looking at it from the bank's point of view, how they're gonna look or they're gonna score a 90-day late more of a negative impact on your credit score than a 30-day late would, okay? So just wanna keep in mind that they're not all scored the same. So to kind of give you guys in a scenario, right? If you're in a situation where you have 2 bills that you need to pay, right? You got a credit card, and let's say you got 2 credit cards, right? That you need to pay off. One of them is already 30 days late from the previous month that you didn't pay, and another one is gonna be 30 days late, right? So which credit card is the best to pay off? In that scenario, you want to pay off the credit card that's about to be 60 days late, because the 60-day late on your credit or on your payment history is going to be a lot worse than you having an additional 30-day late. You see? So that's the kind of way you want to look at it. So that's going to be one of the biggest portions of your credit score, the payment history. That's going to count for 35% of your score. So the easiest way for you to get the full 35% of your points is just by you never missing a payment. So as long as you're not missing payments, you're going to get 100% in this category. The next section is going to be credit card utilization, and that equates for 30% of your credit score. So the way this part is calculated is all they do is they add up all your credit cards that you have. Let's say, for example, that I have 5 credit cards and each of them have a $200 limit on it, right? That's going to equate to a $1,000 limit, right? So what they would do is they'll add up all the credit card limits, get to $1,000 of credit that I have available to me. And what they'll use is they'll take that amount and they'll divide my usage by that amount. So for example, let's say that out of those credit cards, I'm using a total of $200 across those credit cards. So they'll take $200, they'll divide it by 1,000, and that'll give me a credit utilization of 20%, right? So that's how they go about calculating it. Now, guys, with the credit utilization, this is one of the easiest ways for you to be able to quickly increase your score. A lot of times you're going to see, even me, whenever I've dealt with clients, is I've seen that they'll have credit cards that they're pretty much maxed out, like all their credit cards, right? And they might be in the 600s and they're trying to get to the 700s. Well, the first thing I'll recommend to them is finding a way to either pay off your credit cards or acquire new credit. That way you can increase your credit limit, which is thereby decreasing your credit utilization, okay? So that's gonna be the easiest category for you to be able to have a huge credit increase, right? And it's actually you're gonna see in the end how we use this section to be able to get you your score boosted quickly. The third category is going to be your length of credit. Okay, your length of credit history, and so that's going to equate for 15% of your score. This one's a lot harder for you to be able to manipulate. You can't really do much with it. Really, it just comes down to you having, like, if you have like credit card open or auto loan and you've had it for years, the longer you have it, the higher or more points you get in this section of your score, right? So this is a section that you can't do much with. The most you can do is making sure that you're not closing any accounts that you've had open for a long time, depending on how you what other accounts that you have on your credit report, right? So there's not much you can do with this, but this only equates for 15%. So I'm gonna explain even deeper in after I break down the categories, what you should really focus on and how to be able to get into the 700s. Now the fourth category is gonna be type of credit, right? Type of credit is going to equal 10% of your score, and this is another one of those sections where I don't really worry too much about until I focus on the main two. But this one is pretty easy as well. All you really have to do here is, banks want to see that you have a variety of different credit that you're using, right? If all you have is credit cards that you have on your report, and you don't have any type of installment loans, so for example like an auto loan or a home loan, then banks might look at it and say, they're not sure if you can pay something for 5 years straight or 10 years straight, 30 years straight, things like that, right? So they always want to see that you have a mix of different credit. And lastly, the last category, and for some reason the category that seems like people just try to focus on the most, is your credit inquiries. Okay, this one equates for 10% of your score, and for some reason people just love to just focus on this and trying to erase as many credit inquiries as they can off of their credit report, when in reality it's only worth about 10% of your score. I think the only time you should really worry about your those credit inquiries is in a situation where maybe you're applying for a mortgage, right? And at that moment, if they say that you have too many inquiries, then that could be a situation where you want to try to see how you can go about getting it removed. But typically I tell people not to worry about it, just stop applying for credit. If you're currently working to improve your credit and you know that in a year or 2 years time you want to buy a house, then the last thing you should be doing is applying for credit. Like, whenever for example you go to any type of grocery store, you go to Best Buy, even nowadays you can see offers online. They're always trying to offer you credit cards, right? Or store cards. Those are the kind of offers that you want to avoid, because whenever you apply for those, they will eventually have to do a hard inquiry onto your credit score or your credit report, and then that's what's going to ding your credit a little bit. So you want to try to avoid those as much as possible. Now that you have a breakdown of how your credit score is actually calculated, I'm going to tell you one technique that actually impacts the two biggest sections. So it's going to impact about 65% of your score. And what I'm talking about is something called piggybacking, right? A lot of people use that term. I try to explain it more whenever I use it because there's kind of a negative connotation to it, and some people have they call it piggybacking, but they actually do a different technique. And what piggybacking really is, it just means being added as an authorized user on a credit card, right? And so basically, to explain this is, let's say for example, the best way to do this would be, let's say you have a family member or a friend that you trust, right, that has really great credit, right? Or at least they have a credit card in their possession that's in their name, that they don't miss any payments on, and that they have a decently high credit limit on, right? What you want to do is you reach out to this person, you ask them to add you as a credit authorized user. What that really essentially means is you get added onto that card as well. Now the benefit of them adding you to the card means you actually gain all of that credit history that they've had. That positive credit history gets added to your credit report as well. And the another benefit is it's not like you need to have a card issued, right? What typically happens is they put you down as an authorized user, and normally the bank, what they're going to do is they're actually going to send out a card for you, right? Because now the way the bank is looking at it is, now there's two people who are going to be using the same card, and the benefit for them is there's going to be more expenses on it, and maybe they can charge more interest, so on and so forth. But what you can tell the person is that you don't need access to a card. You just want them to add it to your credit report, okay? And once that's done, you will now inherit not only that credit limit, but you'll also inherit the payment history, okay? And what that means is, let's say for example that I have a credit limit right now of $1,000, right? Just from my own credit cards. I have a credit limit of $1,000, and I'm using $500 of that credit limit. Okay, so my credit utilization at that point would be 50%. Now, if I can get someone to add me as an authorized user on a credit card where they have a $4,000 limit and they're not using any of the credit, right? So it's the balance on that card is 0%, and I'm able to get added. Now my credit utilization is going to be 10% because I'm only using $500 of my $1,000 credit card, but I now have another credit card showing on my credit report that has a $4,000 limit, which means now I have a total of $5,000 in available credit, right? So this is really great. It can really help you lower your utilization tremendously, because in that example right there I just gave you, you literally just knocked off 40% of your credit utilization. You can easily see your score jump up, 80 points, 90 points, so on, right? I actually did this technique with a family member, and just by adding them to one of my credit cards that I had, that had I believe at the time it was a $13,000 limit. Just by adding their name as an authorized user on my card, they were able to jump up 75 points that easily, right? Just by doing that technique. So that's the main benefit of why people do that. But another benefit that a lot of people don't think about is you're actually adding on that positive credit history as well, right? So if they haven't been missing any payments, you now inherit that good payment history. So if you had missed payments in the past, you've had like 30 days late, 60-day late showing on your credit report. Now, because you've added this credit card that they've had and they haven't missed payments, you are now adding, let's say that they've had this card for 5 years, right? Or let's just say that they've had this card for 2 years. Okay, so they've had this credit card for 2 years and they haven't missed a payment. So now you are inheriting 24 months of perfect payments, right? And that's going to be added to your credit report. So you can see where that starts to add up, right? It can easily wash away any missed payments that you might have had in the past. Now, the reason why I typically recommend that people look into doing this authorized user technique, if possible, is because now whenever I'm consulting with people and I'm trying to help them fix their credit, I always try to focus on those two biggest categories that we touched before, right? The payment history and the credit utilization. The reason being is that equals 65% of your score. Just right there, those two sections. Now, let's say in theory that you were able to get 100% of those two sections, right? You were able to max out all the points you could get for those two sections. Your score typically, it's gonna range from between 300 to at 850, right? The lowest you can have is a 300, the highest you can have is a 850. Now that means in between there, you have 500 points to play with, right? So you can either gain 500 points or lose 500 points. If you lose all 500 points, you're at a 300. If you gain all 500 points, you're at 850, right? So just the payment history category equates for 192 points, and the credit utilization category equates for 165 points. So just by you maxing out those two categories, you now have 357 points total added to your credit score. And that's not even looking at the other three categories yet. So if you add 357 plus the 300, the 300 that you start with, you're now at a 657 credit score. And we haven't even touched on the other sections yet, right? The other categories. So by you looking at it that way, you see that it's not hard to get to 700, right? Because at that point, you only need about 50 points. We could say you need about 50 points to be able to get into the 700 club. This is why I try to make sure that people realize how beneficial it is to use the authorized user technique. Using that on top of my previous videos that I mentioned where I break down how to get rid of collection accounts. If you haven't seen that video, I'm going to link it down below. But you just using this technique along with dealing with any collection accounts that you have on your credit report is going to put you well into position to get into the 700 club. Alrighty, so that's gonna be pretty much it for this video, guys. If you like the information that I gave in this video, make sure you go ahead and hit the thumbs up button, like this video, hit the subscribe button because I don't want you to miss any other videos about credit, any other credit tips that I give out. And be sure to leave a comment down below with any questions that you might have so I can either shoot a video as well as answer that question directly in the comments. Alrighty, so that's gonna be it for this video, guys. I'll see you at the next one.